So, Tyler, the stock market as a whole has done pretty well in 2023, and that's especially true recently. But one exception is a company called Estee Lauder, ticker symbol is EL, and it's down over a little over 20% so far this year. And when I looked at the chart, most of the decline came in the past couple of months, specifically in May after the company reported earnings. So, for one, what's going on? And two, is it a discount or is it a stock to stay away from?
Well, I mean, let's be clear. Estee Lauder is rarely an expensive stock or a cheap stock, excuse me. And going into this most recent quarter, we were looking at a company that had a price to earnings ratio north of 60. So we're talking about a very expensive stock to begin with. And that kind of sets the situation here where in the most recent quarter, we saw some rather tepid results, specifically in its Asia Pacific region. The Asia Pacific has kind of become the largest or one of the largest segments for them in earnings drivers to a point where, if you see a weakness in that region, it's going to really show up in the bottom line relative to the United States and Europe, which tend to be a little bit more of a consistent sales growth margin sort of environment for them. With that in mind, if people that were buying Estee Lauder at a 60 PE ratio, and all of a sudden sales start to decelerate and free cash flow kind of dries up for a while, you're going to see a lot of people really start to really reevaluate why they are buying that stock in a given moment. So with all of that in mind, it's still not cheap today by any means, even down today. With that, significant down leg after the quarterly earnings report, we're still looking at a stock that's still above 60 or 60 PE of 60 because the earnings decline was so significant. Now, people that are looking at this stock maybe as like, oh, well, it's down. Is it time to buy the dip? I'm going to have people tap the brakes a little bit. This is still a very expensive company. It's a quality company. Don't get me wrong in that sense. It's a company that has a strong portfolio of brands that it continually acquires more and has a wide spectrum in the personal care, perfumes, a lot of other products like that. Many price point brands, so it can kind of target a whole bunch of different audiences all at once. With all of that in mind, if you're starting to see some sort of flatlining or starting to see maybe some issues with growth, maybe it's time to just kind of sit back and watch the stock for a little while. This is one that I personally own, and that's exactly what I plan to do, at least, is see how this kind of all shakes out. And if there does become a more attractive entry point at a more attractive valuation, then I may want to reconsider. But as of right now, it's still a pretty expensive stock.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.